picture the scene you already have in your head. A marble-floored bank in Geneva, Switzerland. A man in a dark suit sliding a briefcase across a polished mahogany desk. A number, no name, no trail, no connection to any government on Earth. That is the image that movies, news headlines, and government press releases have spent decades building in your mind. And here is the part that nobody tells you clearly. That version of offshore banking is gone. In 2010, the United States passed a single piece of legislation that forced every major bank on Earth to choose: report the accounts of American citizens to the IRS, or be financially cut off from the US dollar system entirely. Then, in 2016, the OECD, Organization for Economic Cooperation and Development, launched something even more comprehensive. 116 jurisdictions, automatically sharing financial account data with each other every single year, without any individual investigation being required. 171 million accounts tracked and reportable under this architecture. Approximately 13 trillion euros in assets under surveillance. And since enforcement began, governments collectively recovered approximately 135 billion euros in additional taxes, interest, and penalties directly from the system. The Swiss numbered account, the numbered banking secrecy, the offshore shadow, that world is over. And yet, the ultra-wealthy are still banking offshore. The assets did not come home. The family offices, the institutional funds, the sovereign wealth structures, they are still there, in the same jurisdictions. So the real question, the question that almost nobody answers with precision, is this. If the secrecy is gone, what exactly are they still there for? That is what this entire video is going to answer, with full institutional detail. And I want to be precise about what this video is not arguing before we go anywhere. This is not a video about hiding money from governments. The era of using offshore accounts to conceal assets from tax authorities is functionally over for virtually everyone in a country that participates in the current global reporting architecture. What this video is about is something far more interesting: why sophisticated capital continues to use offshore banking in a world of complete financial transparency, and what structural advantages have survived the full dismantling of secrecy. Because the answer is not what most people expect. Let's start by removing every layer of mythology from this topic and getting to the precise definition. The term offshore banking sounds complicated, secretive, and to most people, slightly illegal. The actual definition contains none of those qualities. Offshore banking, in its precise and institutional definition, is simply this: holding a bank account or financial assets in a jurisdiction other than your country of tax residence. That is the entire definition. Nothing in that definition requires secrecy. Nothing in that definition implies illegality. If you are a tax resident of India and you hold a bank account in Singapore, that is offshore banking. If you are a tax resident of Germany and you hold investment assets in Luxembourg, that is offshore banking. If you are a tax resident of the United States and you hold a savings account in the United Kingdom, that is offshore banking. Millions of internationally mobile individuals, multinational businesses, and institutional investors do exactly this, legally, transparently, with full disclosure to their home tax authorities. So where did the misconception come from? The misconception came from 90 years of reality. From approximately 1934 to approximately 2010, a significant portion of offshore banking was specifically built around legally protected financial secrecy. Real secrecy. Operationally functional secrecy. Secrecy that was backed by criminal law in certain jurisdictions. And understanding how that secrecy actually worked and precisely how it was dismantled is the foundational knowledge you need before any of the modern analysis makes sense. But first, there is one distinction that is non-negotiable to understand, and it is the single most important line in this entire video. Tax avoidance versus tax evasion. These are not the same thing. They are not even approximately the same thing. And the fact that most mainstream media uses them interchangeably is the primary reason public understanding of offshore banking is so deeply distorted. Tax avoidance is the legal structuring of your financial affairs, entirely within the boundaries of applicable law, to minimize your tax liability. Most major corporations on Earth engage in tax planning of this kind. Most qualified tax attorneys in most major jurisdictions are paid specifically to do this. Governments know it happens. They design the tax code with the expectation that it will happen. Tax evasion is categorically different. It is the deliberate concealment of income or assets from tax authorities, failing to report what you are legally required to declare. Tax evasion is a criminal offense in virtually every jurisdiction in the world. Now, FATCA and CRS, which we are going to cover in full detail, were built specifically and exclusively to eliminate tax evasion. They did not make offshore banking illegal. They made hiding money offshore illegal to an unprecedented degree. That distinction is everything. Because once you hold that distinction clearly, the entire structure of why the ultra-wealthy continue to use offshore banking, legally, transparently, with full annual reporting, becomes analytically coherent. And just to be clear, everything we're covering in this video is purely educational. I'm not a financial advisor, and none of this is personal financial advice for your specific situation. And here is what most people miss about the architecture of the global banking system itself. There is no single global banking system. What exists is a network of national and jurisdictional banking systems, each operating under its own regulatory framework, its own central bank policy, its own legal structure, connected to each other through correspondent banking relationships, the SWIFT messaging infrastructure, and various clearing and settlement mechanisms. Every jurisdiction in this network has different rules, different monetary characteristics, different legal protections, and different relationships with every other jurisdiction. This is not a flaw in the architecture. This is the architecture. And the ultra-wealthy understand this multi-jurisdictional network and position their capital within it in ways that most people simply never examine. Now, here is a specific observation worth stopping on before we move into the history. The word offshore appears in more criminal court filings than almost any other term in international finance. It also appears in the corporate structure of the majority of the world's largest and most legitimate investment funds, multinational businesses, and institutional asset managers. Both of those things are simultaneously and verifiably true. And the entire analytical task of this video is to understand the difference between the two uses, and why that difference matters more than the word itself. And if you think the FATCA architecture is an extraordinary piece of financial engineering, wait until we get to the part where the country that built the world's most powerful financial transparency system simultaneously positioned itself as one of the most attractive destinations for internationally mobile capital to escape that same system. That section lands around the halfway point, and it is the most counterintuitive thing in this entire video. If understanding how this global financial architecture actually operates at the institutional level is something you want to go deep on, I made a complete course titled Applied Macroeconomics. It is 10 modules covering the operating system of the global monetary machine, including a dedicated module on how the Eurodollar system works and how offshore dollar creation actually functions at the institutional level. The link is in the description below. Total course video content is 2 hours plus, intentionally built with zero filler. Every module designed for maximum clarity and transferable understanding. It includes direct email support to get your specific questions clarified. And the reason that course connection is directly relevant right now is this. The Eurodollar system, which we are going to cover in detail in this video, is one of the foundational mechanisms that turned offshore banking from a Swiss-centric privacy tool into a global institutional phenomenon. That connection is going to land with much more precision by the time we reach that section. To understand what offshore banking is in the current environment, you have to understand what it was. And the story does not start with a billionaire hiding money. It starts in 1933, in the political environment of pre-war Europe. In 1933, the Nazi government in Germany began systematically attempting to identify the financial assets of Jewish citizens. One of the methods used was pressure on Swiss banking institutions to disclose information about their German account holders. The Swiss federal government recognized what was happening, and in 1934, the Swiss parliament passed the Federal Banking Act. Article 47 of that act made the disclosure of client information to foreign authorities a criminal offense. Not a civil matter, not a regulatory violation, but a criminal offense for any Swiss banker who revealed a client's identity or financial details to a foreign government. This was not, in its origin, a tax evasion tool. It was a protection mechanism designed specifically to prevent a foreign government from using banking information as a weapon against its own citizens. But the structural consequence of that law was immediate and far-reaching in ways the Swiss parliament likely did not fully anticipate. Switzerland had just made banking secrecy a pillar of its legal system, backed by criminal law, and capital from across Europe, and eventually from across the world, began moving there. Not just from people fleeing political persecution, from wealthy families seeking legal protection for their assets, from businesses wanting financial privacy, and in increasing proportion over the following decades, from individuals and entities specifically seeking to place assets outside the visibility of their home country tax authorities. The Swiss banking system grew dramatically through the 1940s and 1950s on the foundation of this legal architecture. And then something happened in the late 1950s and early 1960s that nobody expected to be relevant to offshore banking. The Cold War created an unlikely architect of the modern offshore financial system: the Soviet Union. During the Cold War, the Soviet government needed to hold US dollars for international commodity trading. But they could not hold those dollar deposits in US banks because US authorities had the legal capacity to freeze or seize assets held in US-based institutions if geopolitical tensions escalated to a certain level. So Soviet financial institutions began placing US dollar deposits in European banks, primarily in London, where those dollars were outside US regulatory jurisdiction entirely. These US dollar deposits held in banks outside the United States became known as Eurodollars. And the market that formed around them, the Eurodollar market, became the foundational infrastructure of the modern global offshore financial system. Think about what that actually means. The offshore banking system, in its modern institutional form, was partially constructed by the Soviet Union as a mechanism to hold US dollar reserves outside US government reach. Not by criminal networks, not by tax-evading billionaires. By a sovereign government managing geopolitical risk, using the same structural logic that sophisticated capital continues to use today. The Eurodollar market expanded through the 1960s and 1970s into one of the largest pools of international capital in the world. London became the primary center of this activity, outside US Federal Reserve regulation, outside US interest rate controls, offering flexibility and scale that the onshore US dollar market could not. And simultaneously, a series of small jurisdictions recognized that developing legal and tax frameworks specifically designed to attract international capital could become a complete economic model. The Cayman Islands, a British overseas territory in the Caribbean, built a financial services sector with no corporate income tax, no capital gains tax, and a legal framework modeled on English common law. The British Virgin Islands developed corporate registry infrastructure that became one of the most widely used globally for structuring international business and investment vehicles. Jersey, Guernsey, and the Isle of Man, crown dependencies of the United Kingdom, developed sophisticated trust law and fund administration frameworks. Luxembourg positioned itself as the cross-border fund domicile of choice within the European context. Liechtenstein developed private foundation and trust structures with specific characteristics for long-horizon wealth preservation. Panama built corporate registry infrastructure that allowed the rapid and inexpensive incorporation of international business companies. By the 1980s and 1990s, these were not fringe locations on the periphery of global finance. They were integral operational nodes in the flows of institutional capital worldwide. And here is the part that most explanations get fundamentally wrong. They frame offshore financial centers as primarily criminal infrastructure. The reality is more complex and more institutionally interesting. Legitimate multinational corporations use these jurisdictions to structure cross-border investments efficiently. Institutional investors, pension funds, endowments, insurance companies used Cayman-domiciled vehicles to access alternative investments. Wealthy families used Swiss and Channel Island structures for estate planning, generational wealth transfer, and multi-currency asset management. And in a significant proportion of cases, yes, individuals and entities use the same jurisdictions, the same legal structures, and the same banking relationships to deliberately place assets outside the visibility of their home country tax authorities. All four simultaneously, using identical infrastructure. This is the structural reality that makes offshore banking genuinely complex. The same legal architecture served entirely different purposes depending on who was using it and why. Now, the numbered account. This is almost certainly the most misunderstood element of the offshore banking mythology. A Swiss numbered account was not anonymous. The bank knew exactly who held the account. What the numbered account structure meant was this. Instead of the account holder's name appearing on internal communications, external references, and correspondence, only the account number was used. The account holder's identity was held by a small number of specifically designated senior bank officials under strict internal confidentiality protocols. So the account was not anonymous. It was pseudonymous internally and legally shielded from any external disclosure under the criminal provisions of Swiss banking law. For a tax authority attempting to identify whether a specific person held assets at a Swiss bank, the numbered account structure meant that even a formal inquiry might receive a denial, not because the bank was lying about account existence, but because the bank was legally prohibited from confirming or denying client relationships with external parties. That was the functional reality of Swiss banking secrecy, not invisibility, but legally protected non-disclosure. And for the wealthy individuals and families who used it across multiple decades, it was an extraordinarily effective structure. By the early 2000s, estimates for institutions, including the Bank for International Settlements, suggested that somewhere in the range of $7 to $8 trillion in assets were held in offshore financial centers globally. The system was large, institutionally embedded, and operating with remarkable stability. And then two things happened in relatively rapid succession that permanently changed the architecture. The first was a US Senate investigation that revealed something more organized than anyone had publicly acknowledged. The second was the largest data leak in the history of international finance. Let's cover both, because understanding them is the only way to understand why the global system looks the way it does today. In 2007, the U.S. Senate Permanent Subcommittee on Investigations began a detailed examination of the role of UBS, Switzerland's largest bank, in facilitating tax evasion by American clients. What investigators found was not passive banking, a bank that simply happened to hold accounts that Americans failed to declare. What they found was an active, organized program. UBS bankers were documented traveling to the United States on tourist visas, not work visas, meeting with American clients, discussing how to structure accounts to avoid IRS detection, and facilitating the movement of assets into Swiss accounts that were never disclosed to US tax authorities. The scale was significant. At the peak of the program, UBS reportedly managed approximately $20 billion in assets for US clients through structures designed around non-disclosure. In 2009, UBS reached a settlement with the US Department of Justice. The financial penalty was approximately $780 million. And as a condition of the settlement, UBS disclosed the names of approximately 4,450 American clients who held undeclared accounts, a direct breach of Swiss banking secrecy law, authorized by the Swiss government under exceptional pressure. For the Swiss banking system, that moment was a structural rupture. The criminal protection of Article 47, the cornerstone of Swiss financial law since 1934, had just been overridden, not because of a philosophical shift in Swiss banking culture. Because the legal and financial pressure applied by the US government was of a scale the Swiss banking system could not absorb. And the US government recognized precisely what that pressure had demonstrated. If the threat of losing access to the US financial system could force the disclosure of 4,450 names from Switzerland, imagine what it could do applied globally. Which is exactly what happened next. Then came April 3, 2016. A German newspaper, Süddeutsche Zeitung, received approximately 11.5 million confidential documents from an anonymous source connected to a Panamanian law firm called Mossack Fonseca. The documents revealed approximately 214,000 offshore entities, shell companies, trusts, and foundations linked to clients across more than 200 countries and territories. Among those linked, approximately 12 current or former heads of state and approximately 143 politicians and public officials across multiple countries. The Panama Papers were not primarily a story about criminal activity in the traditional sense. They were a story about how normalized the use of offshore corporate architecture had become across politics, across business, across institutional finance, at a truly global scale. Many of the structures revealed were entirely legal in the jurisdictions where they were established. The controversy was not primarily legal. It was about the gap between the private financial behavior of public figures and the public positions many of them held on tax policy. And in 2021, the Pandora Papers extended this picture further. Approximately 11.9 million documents from 14 different financial services providers across multiple continents, revealing offshore structures used by approximately 330 politicians across 90 countries. By the time the Pandora Papers published, the public narrative about offshore banking had permanently shifted. And the regulatory architecture that replaced the old system had already been under active construction for over a decade before either leak occurred. The Foreign Account Tax Compliance Act, FATCA, was passed by the US Congress in March 2010 as part of a piece of legislation called the Hiring Incentives to Restore Employment Act. It received almost no public attention at the time of passage. Think about what that means. The piece of legislation that forced every major bank on Earth to choose between compliance and being cut off from the US dollar system passed inside a jobs bill. Almost nobody noticed. FATCA was buried inside it. And what it did to the global banking system was structurally extraordinary. FATCA created a binary choice. Not a request, not a regulatory guideline, but a genuine binary choice for every foreign financial institution on Earth. Option 1. Register with the IRS. Agree to identify all account holders who are US persons and report their account information, account balances, interest income, dividend income, gross proceeds from sales, directly to the IRS on an annual basis. Option 2. Refuse to comply. and face a mandatory 30% withholding tax on all U.S. source payments flowing to that institution. To understand why this was effective, you need to understand what U.S. source payments means in practice. Because the U.S. dollar is the dominant settlement currency in global trade, used in approximately 80% of global commodity transactions and the majority of international financial flows, virtually no foreign bank of any meaningful operational scale could afford to lose access to U.S. source dollar payments. The compliance rate was not voluntary in any meaningful sense. It was structurally compelled. As of the current period, over 100,000 foreign financial institutions across more than 100 jurisdictions are registered as FATCA compliant, reporting U.S. account holder data to the IRS annually. This is not a reporting request that some banks chose to honor and others chose to ignore. This is a global compliance infrastructure that deploys the threat of financial exclusion from the U.S. system built in approximately 5 years. And the data point that makes this concrete? If you are a U.S. citizen or permanent resident, and you open a bank account in Singapore, in Switzerland, in the UAE, in the Cayman Islands, that bank is now legally required to report your account details, your balances, and your income to the IRS. Without you doing anything, without any investigation being opened, automatically and annually. Now, here is something that nobody in mainstream financial coverage explains with the precision it deserves. The United States built the most powerful financial transparency enforcement mechanism in history, and then declined to join the equivalent multilateral global system that FATCA directly inspired. The Common Reporting Standard, CRS, was developed by the OECD in 2014, explicitly modeled on the structural logic of FATCA. It came into force across the first wave of participating jurisdictions in 2016 and 2017. CRS operates on a multilateral, automatic information exchange basis. Every participating jurisdiction's financial institutions identify their account holders who are tax residents of other CRS participating countries. They report those account details: name, address, tax identification number, account balance, interest, dividends, and gross proceeds to their own government's financial regulator. That regulator then automatically transmits the information to the tax authority of the account holder's home country, annually, without an investigation, without a court order, automatically, as a routine operational process. As of the current period, 116 jurisdictions participate in CRS. 171 million accounts are reported under this system annually. Approximately 13 trillion euros in assets are tracked and reportable. And governments participating in CRS have collectively recovered approximately 135 billion euros in additional taxes, interest, and penalties since the system became operational. These are not projections. These are published OECD figures. The United States is not in this system. The U.S. receives comprehensive account data on American citizens abroad through FATCA, but the U.S. does not reciprocate with the same depth of automatic reporting to other countries about their citizens' U.S.-held assets. Foreign governments receive some information about their citizens' U.S.-held accounts, but not the comprehensive, automatically exchanged dataset that full CRS participation would require the U.S. to provide. And here is the structural consequence of that asymmetry, and it is genuinely one of the most significant and least discussed facts in international finance. The United States has effectively positioned itself as one of the most significant remaining jurisdictions offering regulatory separation for internationally mobile capital for non-U.S. persons. A non-U.S. resident with properly structured U.S. banking or investment arrangements using the appropriate IRS documentation for non-resident status can hold assets in the United States with minimal automatic reporting to their home country government. Delaware LLCs, Nevada corporations, and certain US-based trust structures have become increasingly discussed in international wealth management circles, specifically because of this asymmetry. all of which, to be precise, require full legal compliance with IRS reporting obligations, proper documentation of non-resident status, and qualified tax advice. This is not a structure you assemble informally. This is not a loophole that regulators missed. It is the direct and intended structural consequence of the U.S. choosing to build FATCA rather than participate in CRS. The country that was the loudest architect of global financial transparency built the system in a way that positioned the United States itself as a preferred destination for internationally mobile capital seeking a degree of regulatory separation from home country automatic reporting. And I want to be precise about what this does and does not mean. U.S.-held assets are not invisible. FATCA operates domestically. The IRS has significant information on foreign persons with U.S. financial interests. But the depth of automatic bilateral annual exchange that CRS provides between 116 participating jurisdictions simply does not apply on the outbound U.S. side in the same way. That asymmetry is on the public record. It is foundational to the architecture, and it is one of the most intellectually interesting facts about the modern offshore landscape. Now, what does CRS mean in practice for someone holding an account in one of the 116 participating jurisdictions? Your bank identifies you as a tax resident of another participating country. Your bank reports your account details, balance, interest, dividends, gross proceeds, to the financial regulator of the country it operates in. That regulator transmits that information to the tax authority of your home country every year, automatically. This means a Swiss bank account held by a French tax resident is reported to the French tax authority annually. A Singapore account held by an Indian tax resident is reported to the Indian tax authority annually. A Cayman Islands investment fund account held by a UK tax resident is reported to HMRC annually. The numbered account, the confidential private banking relationship, the informational privacy that the old system was built on, gone for virtually every individual who is a tax resident of a CRS participating country. And on top of FATCA and CRS, the European Union has been progressively implementing a series of anti-money laundering directives, a regulatory framework that adds another layer, specifically targeting the corporate opacity that offshore structures traditionally relied on. These directives require EU member states to maintain registers of the beneficial ownership of corporate entities, meaning the actual human beings who ultimately own and control companies, and in many cases to make that information publicly accessible. The pressure from these directives has extended well beyond EU borders. Major offshore centers, including the BVI, Cayman Islands, Jersey, and Guernsey, have all faced increasing requirements to establish and maintain beneficial ownership registries as conditions of maintaining their access to international financial networks. The architecture of anonymity that the offshore system was built on has been systematically dismantled, layer by layer, regulation by regulation, over approximately 15 years of coordinated international regulatory activity. The numbered account is gone. The shell company with no disclosed owner is increasingly gone. The confidential Swiss banking relationship, immune from foreign government inquiry, is gone. And yet, here is the data point that most people never sit with long enough to question. The assets did not come home. Global cross-border banking assets, capital held in jurisdictions other than the account holder's home country, remain at a scale of multiple trillions of dollars, which means sophisticated capital is still using offshore banking infrastructure in a fully transparent, fully reported, fully disclosed environment. Which means the ultra-wealthy were never primarily there for the secrecy. And this is where the analysis gets genuinely interesting. There are three distinct structural reasons why sophisticated capital continues to use offshore banking architecture in the current fully transparent environment. Not one reason applied at different scales. Three independently compelling reasons, each of which survives the complete elimination of financial secrecy. And none of them require hiding anything. The first is multi-currency access and currency risk management. Here is a structural reality that most people never fully consider. Holding the entirety of your net worth in a single currency issued by a single central bank, managed according to a single government's monetary and fiscal priorities, is a concentration risk of a specific and well-recorded kind. And the historical record on what that concentration risk produces is extensive. In 2018, the Turkish lira lost approximately 30% of its value against the US dollar within a single year, driven by a combination of high inflation, external debt obligations, and central bank policy decisions. In the period between 2022 and 2023, the Argentine peso underwent multiple significant devaluations, losing the substantial majority of its purchasing power against major currencies over that period, driven by fiscal imbalances and monetary expansion. The Egyptian pound, the Pakistani rupee, the Nigerian naira, multiple currencies experienced significant devaluations in relatively recent periods. None of these are obscure historical examples requiring specialized knowledge to locate. These are recent, verifiable events affecting tens of millions of people's actual purchasing power in the real economy. And the mechanism is consistent across all of them. Government spending commitments that exceed revenue, financed through the issuance of new currency, which increases the money supply without a corresponding increase in economic output, reducing the purchasing power of each unit of currency in circulation. Now, here is what most discussions of currency risk miss entirely. Currency devaluation does not affect all asset classes equally, even for people in the affected country. If your wealth is concentrated in assets denominated in a devaluing currency, domestic bank deposits, domestic bonds, domestic real estate priced in local currency terms, the devaluation reduces the real purchasing power of those assets, even if their nominal local currency value appears unchanged. But if a meaningful portion of your wealth is held in accounts denominated in currencies managed under separate and independent monetary policy frameworks, the Swiss franc, the Singapore dollar, the US dollar, the UAE dirham, the devaluation of your home currency does not directly reduce the real value of those separate holdings. This is not an exotic financial engineering strategy. It is the same structural logic as any form of insurance. You hold a separately structured asset that performs independently of the primary risk you are managing against. An offshore multi-currency account in Singapore or Switzerland, held by someone whose home country runs persistent monetary expansion, fully disclosed to all relevant tax authorities, fully taxed on the returns it generates, is a straightforward and institutionally well-established form of currency risk management. And for individuals and families operating across multiple countries, conducting business in multiple currencies, managing assets in multiple jurisdictions, the operational advantages of multi-currency offshore accounts go beyond just risk management. The ability to receive, hold, and deploy capital in multiple currencies from a single institutional relationship without converting through multiple domestic banking systems is a real operational efficiency that compounds in value as the scale and international complexity of the individual's financial life increases. The second structural reason is the legal architecture and asset protection. And this is where the genuine differences between jurisdictions become analytically important, because they are not differences in secrecy levels. They are differences in legal infrastructure quality for specific purposes. Start with the Cayman Islands, because the Cayman example is the clearest illustration of this point. According to industry estimates, approximately 70% of the world's hedge funds maintain their legal domicile in the Cayman Islands. Not because the Cayman Islands offer secrecy that other jurisdictions do not. The Cayman Islands is fully CRS compliant, maintains a beneficial ownership registry framework, and participates in international information exchange. Institutional investors holding Cayman-domiciled fund interests receive no meaningful privacy advantage from that structure in the current environment. So why are approximately 70% of global hedge funds domiciled there? Because the Cayman Islands offers a neutral legal jurisdiction, independent from any single major power's regulatory priorities, with decades of established case law specifically governing investment fund structures, a legal framework built on English common law with highly predictable enforcement, and a fund structuring efficiency that allows institutional capital to be organized and managed for global investor distribution without the cross-border regulatory friction that onshore domiciliation in any major market creates. This is pure legal architecture. Luxembourg serves a directly analogous function in the European context. Luxembourg is the second largest investment fund domicile in the world by assets under management, behind only the United States. The UCITS framework, Undertakings for Collective Investment in Transferable Securities, which governs the cross-border distribution of retail investment funds across the European Union and a growing number of markets beyond it, is primarily structured through Luxembourg's legal and regulatory infrastructure. Not for secrecy, for legal architecture efficiency. The majority of the world's major asset management firms, from large US headquartered institutions to Asian and European managers, use Luxembourg-domiciled UCITS funds as their primary vehicle for European and international retail distribution. Because the legal framework works. Because the regulatory environment is well established. Because the case law is predictable. Now, within the asset protection dimension, there is a specific use case that matters for high net worth individuals, distinct from institutional fund structures. Offshore trust structures, and specifically properly structured discretionary trusts in jurisdictions with well-developed trust law, provide genuine legal separation between the assets settled into the trust and the personal liability exposure of the individual who established it. In a number of offshore jurisdictions with well-developed trust law, including the Cayman Islands, Jersey, and certain other common law jurisdictions, a properly structured offshore trust can provide meaningful creditor protection, meaning that assets within the trust structure may be shielded from personal creditors of the person who established it, subject to the specific legal requirements of the relevant jurisdiction. This matters in contexts involving significant business liability exposure, professional liability risk, or litigation environments where personal wealth could be at risk from claims unrelated to criminal conduct. Estate planning and multi-generational succession architecture are additional established use cases, organizing how wealth transfers across generations in a legally clear, tax-efficient, and administratively manageable way across multiple countries simultaneously. All of this is fully compliant with the current reporting architecture. The trust is disclosed to relevant tax authorities. The beneficial ownership is reported. The income generated within the structure is taxed according to the rules of the relevant jurisdictions. The structural advantage is not invisibility. It is legal clarity, architectural precision, and legitimate separation of assets for specific established purposes. The third reason, and the one that the data on this makes most difficult to dismiss, is jurisdictional diversification as a rational architectural response to observed sovereign risk. This is the reason that is almost never discussed clearly in mainstream financial content, and it is worth examining precisely. Here is the observed institutional behavior pattern across established family offices, major sovereign wealth funds, and institutional endowments. Assets are distributed across multiple jurisdictions, not because these institutions assume their home governments are corrupt or unstable, but because a financial architecture built to function across multiple generations, across political cycles, economic cycles, and geopolitical shifts that cannot be predicted with any precision, does not concentrate all exposure in any single sovereign's decisions. This is not paranoia. This is established institutional practice. And the historical record that informs it is not speculative. Capital controls, government-imposed restrictions on moving money in or out of a country, have been implemented across multiple economies in periods of economic stress. Iceland imposed capital controls in 2008, following the collapse of its banking system. Cyprus imposed capital controls in 2013 during its sovereign debt restructuring. Argentina has implemented multiple distinct rounds of capital controls across different decades, restricting the ability of residents to convert local currency to foreign currencies or move capital internationally. These are not examples from uniquely fragile economies selected to prove a point. The mechanism of capital controls, asset freezes, and regulatory restructuring of financial arrangements is a policy tool available to governments across a wide range of political and economic contexts. It has been used, and continues to be available for use, in circumstances that the people affected by it did not anticipate. A family office managing wealth across 3 or 4 generations does not build its architecture on the assumption that no government will ever implement policies that adversely affect capital held exclusively within its borders. It builds architecture that distributes exposure across multiple jurisdictions, so that even in an adverse scenario in one location, the overall wealth preservation objective remains structurally intact. And it does this while remaining fully compliant with the reporting requirements of every jurisdiction involved. Because in the current transparent environment, the structural benefits of jurisdictional diversification are entirely accessible within a fully disclosed and legally compliant framework. You do not need secrecy to benefit from multi-jurisdictional architecture. You need proper legal structuring and qualified advisors who understand the reporting obligations in every jurisdiction involved, and a capital base where those costs make structural sense. That distinction between secrecy-dependent architecture and structure-dependent architecture is the entire core of what modern offshore banking actually is, and why it persists. So, what does the modern offshore banking landscape actually look like in operational practice? Let's go through the jurisdictions that matter most in the current environment, and what each one genuinely offers. Singapore first. Singapore is, by the most relevant institutional measures, the premier wealth management center in Asia, and increasingly one of the most significant globally. The Monetary Authority of Singapore, the MAS, operates a regulatory framework that is widely regarded as rigorous, consistently enforced, and operationally stable. Singapore participates fully in CRS. Accounts held in Singapore by foreign tax residents are reported to their home country tax authorities automatically. There is no meaningful informational privacy advantage to banking in Singapore compared to banking in your home country, from the perspective of your home government's visibility into your assets. So what remains? The Singapore dollar is managed under a genuinely unusual monetary policy framework. Rather than targeting an interest rate the way most major central banks do, the Monetary Authority of Singapore manages the Singapore dollar within a policy band against a trade-weighted basket of currencies, adjusting the center of that band and its width based on its assessment of the appropriate monetary conditions for Singapore's economy. This produces a currency with a specific and historically established stability characteristic, one that has consistently appreciated in real terms over multi-decade periods. Singapore offers multi-currency account structures, sophisticated private banking relationships, direct access to Asian capital markets, and a legal system based on English common law with a well-established track record of contract enforceability. The Singapore government has also introduced specific regulatory frameworks designed to attract family offices, including the variable capital company structure and associated tax incentive schemes, making Singapore explicitly competitive for institutional wealth management mandates from across Asia and beyond. According to the Monetary Authority of Singapore's published industry data, Singapore's financial sector manages approximately $3 to $4 trillion in assets, a figure that has grown substantially over the past decade and that continues to expand as capital from across Asia seeks institutionally credible management infrastructure. Switzerland, transformed but not irrelevant. Swiss banking secrecy, as the pre-2009 world knew it, is gone. Switzerland participates in CRS. The numbered account as a functional privacy mechanism is not operationally significant in the current environment. But dismissing Switzerland as a relevant offshore banking center based on that fact alone is an analytical error. The Swiss franc is one of the historically most stable currencies in the world, a characteristic that reflects Switzerland's political neutrality across major conflicts spanning well over a century, its persistent current account surplus, its strong institutional framework, and its independent central bank. Swiss private banking infrastructure has centuries of accumulated institutional knowledge in discretionary portfolio management, precious metals custody, long-horizon wealth preservation strategy, and multi-generational family wealth relationships. Switzerland's political stability, neutral in major geopolitical conflicts, with a stable constitutional framework and strong rule of law, remains a structural characteristic that institutional capital with a genuine multi-generational mandate continues to value. Not because Switzerland offers secrecy, because it offers predictability. And predictability across a long enough time horizon is one of the most valuable and scarce characteristics in any financial jurisdiction. The United Arab Emirates, and specifically the Dubai International Financial Center. The DIFC is a financial free zone within Dubai that operates under its own legal framework, modeled on English common law, entirely separate from the UAE civil law system. This means disputes within the DIFC are adjudicated under common law principles by a judiciary specifically established for international commercial and financial matters. The UAE participates in CRS commitments and international information exchange frameworks. There is no personal income tax in the UAE, and this is worth being precise about, because the absence of personal income tax does not make the UAE a mechanism for citizens of other countries to evade their home country tax obligations. A tax resident of India holding assets in the UAE remains legally subject to Indian tax obligations on the returns generated by those assets. But for individuals who have genuinely and legally relocated their tax residency to the UAE through legitimate residency programs, physical presence requirements, and the associated administrative processes, the UAE's zero personal income tax environment is entirely legal and fully compliant with international standards. The DIFC has developed into a hub for family offices, private equity structures, and institutional wealth management, serving the Gulf, broader Middle Eastern, and South and Southeast Asian markets. And as someone who has spent significant time researching what multi-jurisdictional financial architecture looks like for building across borders, this is a jurisdiction that warrants careful and informed examination. The Cayman Islands, the institutional fund domicile. For most private individuals, the Cayman Islands is not a practical or particularly accessible personal banking destination in the current regulatory environment. The minimum account relationship requirements at Cayman-based private banks are substantial. The compliance onboarding process is extensive, and the informational privacy advantages that once existed have been substantially eroded by CRS and beneficial ownership requirements. But what the Cayman Islands remains, and has strengthened rather than weakened over the past 2 decades, is the world's dominant hedge fund and alternative investment fund domicile. That same institutional concentration we covered earlier, approximately 70% of global hedge funds domiciled here, did not shrink when CRS arrived. The reasons are entirely foundational. Neutral jurisdiction, well-established legal precedent for complex fund structures, flexible fund formation mechanics, efficient and experienced fund administration infrastructure, and a regulatory environment specifically calibrated for the operational requirements of institutional investment management. None of those advantages disappeared with the introduction of CRS, because they were never about secrecy in the first place. Luxembourg, the European fund infrastructure. Luxembourg is the world's second-largest investment fund domicile by assets under management, behind only the United States, with a fund industry that manages trillions of euros in assets across thousands of individual fund structures. The UCITS framework, which governs the cross-border distribution of retail investment funds across the European Union and is recognized as a passport for fund distribution in a growing number of markets globally, operates primarily through Luxembourg's legal and regulatory infrastructure. The majority of the world's major asset management institutions use Luxembourg-domiciled UCITS funds as their primary vehicle for European and international distribution. And this is the broader institutional point that the entire jurisdictional landscape illustrates. The most durable advantages that major offshore financial centers offer in the current environment are not about hiding anything. They are about legal architecture quality, monetary policy independence, regulatory framework efficiency, and multi-jurisdictional diversification, all of which are entirely accessible within a fully transparent and disclosed framework. The Swiss bank secret is dead. The structures that replaced it are more sophisticated, more institutionally embedded, and, for the people who understand them correctly, more genuinely powerful than the old secrecy-dependent architecture ever was. And now, the honest answer. The one that most finance content skips. The version of offshore banking that actually works, the architecture that the ultra-wealthy actually use, is not a product you can simply go and open next week. It requires proper legal structuring across multiple jurisdictions because the compliance requirements, the legal frameworks, and the tax implications in each location interact with each other in ways that require specialist knowledge to navigate correctly. It requires qualified tax advisors who understand the specific reporting obligations in your home country, the specific rules of each jurisdiction where you hold assets, and the interaction between them, because getting those interactions wrong creates liability rather than eliminating it. It requires ongoing compliance, annual reporting obligations, account maintenance requirements, and consistent adherence to the evolving regulatory frameworks of every jurisdiction involved. And critically, it requires a level of capital and international operational complexity where those professional costs make structural sense. Below a certain threshold, the annual fees for qualified legal structuring, specialist tax advice across multiple jurisdictions, and ongoing compliance administration can outweigh the structural benefits for most individuals. That is not a reason to dismiss the concept. It is the accurate map of the terrain. And the honest answer is that most mainstream content on this topic skips that map entirely, either making offshore banking sound like a universally accessible tax avoidance magic trick, or making it sound like an exclusively criminal enterprise. Neither framing is accurate. The accurate framing is this: offshore banking is a sophisticated institutional tool, one that delivers real structural advantages in the right context, with the right structuring, at the right scale of capital and complexity. Understanding the system, knowing what it is, what it was, how it was transformed, and what the legitimate modern architecture looks like, is the prerequisite for eventually being in a position to use it correctly, or to recognize when others are using it well. The ultra-wealthy did not begin using offshore architecture after they became wealthy. In the vast majority of established cases, they understood these systems, the mechanics, the jurisdictional characteristics, the structural logic, before they needed them at scale. That understanding is the actual advantage, not the account itself. The comprehension of how the global financial architecture operates and why it operates that way. And I want to close with one precise observation. The regulatory evolution of the past 15 years has not eliminated offshore banking. It has selected for the version of it that is worth taking seriously. The secrecy-dependent architecture, the numbered account, the shell company with no disclosed owner, the confidential private banking relationship immune from regulatory scrutiny. That version could not survive a world of 116 jurisdiction automatic information exchange. And it did not. What survived is the version built on genuine legal architecture, jurisdictional intelligence, multi-currency diversification, and structural resilience. because those things are not destroyed by transparency. They are entirely compatible with it. And the fact that the structural case for offshore banking is actually stronger in a transparent world than it was in a secret one, is the most counterintuitive and most important thing this entire video has been building toward. This is genuinely uncertain territory, in the sense that the regulatory landscape continues to evolve. More jurisdictions are signing CRS commitments, beneficial ownership disclosure requirements are tightening progressively, and anyone who presents the current architecture as permanent is making a claim the data does not support. But the structural logic of why sophisticated capital distributes exposure across multiple jurisdictions, that logic is not a product of secrecy. It is a product of sound architecture. And sound architecture does not become irrelevant because the environment changes. It adapts. Since you stayed all the way to the end of this video, it's clear this topic genuinely interests you at a level beyond the surface, and I think the videos appearing on your screen right now are going to take that further. They go deeper into the institutional financial systems we examined here, and they will add precision to the framework we've built in ways I think you'll find genuinely valuable. If this video added something for you, hit like and subscribe for more structural analysis of how the global financial machine actually operates. Thanks for watching.